Hi, I'm Mike Ward. I want to very briefly take you through the FamaFrench 5-factor model and compare it to some of the styles that Chris Muller and myself have been working on for some time. And we're also going to just introduce a hedge fund type approach, which we think may be useful for investing in the Johannesburg Stock Exchange. Now, you will know, or let me perhaps give you some insight, first of all, between the difference between what we refer to as styles versus the Fama and French factors. Styles, things like momentum, earnings, value versus growth, those kinds of things, size and so on. We have done our research on long-only portfolios. We've also taken the 160 companies that list on the JSE, the largest ones, and broken them into quintiles. So that 5 portfolios of 32 companies, equal weighted and so on. And this allows us to look at more concentrated portfolios and also to check the rankings of how these portfolios do. We can also examine nonlinear type styles. So for example, something like interest cover. The ideal interest cover is not a very high one or a very low one, it's somewhere in the middle. The same applies to things like ROE. So Fama and French use factors. They take a portfolio of long shares, which they own, and they subtract a portfolio of short shares that they sell. And they tend to divide things 50-50. So you're either long or you're short. And this gives the benefit of having a market neutral type portfolio, which we'll talk about, which is useful in the hedge fund that we'll get to a bit later. But it has some downsides. It's less concentrated and usually doesn't manage the linearities quite as well. So just to illustrate this, here is a typical plot that Chris and I would have produced over the years and this one is looking at the value versus growth style, and we're using here earnings yield, the inverse of the price to earnings ratio, if you like. For Fama and French, they use a different metric for this. They use the book to market ratio. And we think this is actually better. So I'm showing you this one. And I'm showing you how we do it. We would start, say, in 1987, find the top the largest 160 companies that existed then, and work out their earnings yield, rank them, and then put them into 5 portfolios, equal weighted. And then we rebalance this, looking for new companies and so on, each quarter, usually every 3 months. And you can see what we're seeing here is this red line, which is the time series of the plot of this. And it's showing us a 21.8% return. This is an annualized return over this entire period. And you'll notice here is portfolio number 2, and then 3, and number 4. So these are not exactly linear like we like to see, but they're close. And then but these 3 are bunched together. And then number 5 down over here. And we like to also plot the benchmark, which is the all share index. The T is a total return. These returns include dividends. And we like to show the price relative. So this one here is looking at the difference between portfolio 1 and portfolio 5. And this one down here is looking at the difference between portfolio 1 and the index, the benchmark over here. And so now, just to contrast this with the Fama-French methodology, they would have grouped what we've called portfolio 1 and 2 and half of portfolio 3. So they take half the data here, put it into their one portfolio. This is the high portfolio, high book to market that they would use here. And they're going to get a return of that of about 18.5, somewhere in the middle here, because it's all of those shares. And they're going to subtract the rest of it, which is half of portfolio 3, 4, and 5, which is going to give them a return somewhere here, 14.3. And that minus that's going to give them their factor of 4.25. And so they'll show this and they'll tell you that there is a factor, a risk premium, if you like, which relates to the value versus growth in terms measured with the book to market value in their case. Now, I want to show you what what we've done. So we're looking at the FamaFrench 5-factor model. And the first one is really the default one. This is the market risk premium that you'll all be familiar with. So we're taking the return on the market minus the return on a benchmark risk-free long-term government bond, in fact. And they also look at the size effect. Here they're using market cap, and they find small companies outperform big companies, so they call this small minus big. Then there's the value growth one. This is one I've just been showing you. They use book to market, and high minus low is their factor here. And they've added two more, one which relates to the operating profit margins of companies. They call the strong ones, the higher ones, robust versus the weaker ones, which are the low ones. So they've got high minus low here. They call it R minus W, robust minus weak. And then there's a fifth factor, which relates to investment, actually CapEx. And they look at companies in terms of how much they're increasing their assets by. And like many researchers, they find that companies that don't spend a lot on CapEx do better than ones that do. So they call these conservative. And this portfolio is aggressive, and they call that C minus A. So that's how they're working out their factors. Now, we take JSE data back to 1984 using the top 160 shares, which we keep refreshing. We do this monthly. We use total return, so we're including dividends. We make sure we have no survivorship bias in the data, and we deal with corporate actions, share splits, takeovers, etc. Now, let me show you what we get. So we've got 29 years of data here, and you can see that the market risk premium, RM minus RF here, is actually only about 1% over this period. Mostly, I think most people would like to say it's more like 5%, but we're not finding that. That's largely because, in fact, risk-free assets have done pretty well over this period. The second factor we look at here is their size factor. So this is small minus big. And they would expect to see a positive number here. They think there's a small size effect. We and lots of research on the JSE has shown that there's either no size effect on the JSE or it's slightly negative. We're finding here a small negative size effect over here. And then we look at the value versus growth effect here. Basically very little. We're not finding much of an effect over this period here. And if we look at their two more recent factors, this is their profit, robust minus weak. And you can see slightly positive for companies which have got slightly higher operating profits. And the biggest factor that they're showing here, and I say biggest, but it's only 3.1%. Remember that. This is looking at companies which don't invest, conservative minus those that do invest in assets. Now, so first of all, you'll notice these factors are actually quite small relatively. And not only that, but if you plot the time series of these, you're going to see that they're not very consistent. So you can see here, for example, that let's have a look at small minus big over here, for example. And you'll see that there was, in fact, a positive size effect. In other words, small companies did better than big companies for about the first 10 years of our data here. And then it kind of drops off and remains pretty constant for a while. And then pretty much over the last 10 years over here, you can see it's been going the other way. Large companies have outperformed. So this is not a consistent style. It's up, then flat, and then down. And similarly, if you look at this is their value growth effect, high minus low, you can see, in fact, that value shares did very badly, and then they did well, and then they've been pretty flat over this period. The only one which really does seem to be relatively consistent is the conservative minus aggressive here. This is the investment style that they talk about over here. So you can see that it is a problem just to, in a sense, report one number like they do. And looking at the time series is actually very constructive. Now, we thought that it would be worthwhile looking at other styles, treating them as factors, because we, over the years, have looked at couple of hundred different styles, and these are some of the better known ones: momentum, volatility, beta, ROE, interest cover, and so on. And so here we're going to, and here I'm just describing the way in which these work. So momentum, we would want a 12-month look back. We're going to hold for 3 months actually, and we want positive shares we know do better than negative shares. So if you've got positive momentum, you're going up, you're going to do better than shares which are going down, and so on, or which have less momentum, we should say, and so on. So you'll see a couple of these as well, like ROE and interest cover here. Because these are not linear, we want the middle part, as I described earlier. We want interest cover to be somewhere in the middle. Actually, interest cover around about 8 times is pretty good, and we're subtracting anything in the tails now. So if it's high or low, we kind of are modifying this to make it kind of linear, if you like. So what do we get? Well, so you can see over this period here, slightly less period than we looked at earlier here, you can see we've got a very strong positive momentum factor here. Remember, we saw just now about 3% from the conservative minus aggressive factor that FamaFrench showed. So this is 3 times bigger than that. So it's quite important. And this is just a benchmark here. This is the all bond index. So it's like a risk-free benchmark here. And then this is our value growth factor using earnings yield, which we think is better than market to book, and volatility. And you can see some others here, beta, interest cover, and so on, didn't do as well. Now, if we plot the time series of these factors here, you'll see that if you take momentum, for example, here, and now we're going back to 2001 just to show you this, you can see momentum is actually pretty consistently upwards over here. And this is the index, the all bond return. We're going to talk a little bit more about that later. And then you can see some of the others over here. But you'll notice that generally speaking here, most of these are fairly consistently upwards. They don't seem to really, they may be flat for a bit, except perhaps this one here, which is the market risk premium here, which is kind of going all over the show here. So we think it's worth maybe looking at some of these other factors as well. So what we then did was we realized that there's a lot of correlation between these different factors. And you can see, for example, that volatility is quite strongly negatively correlated with market cap for whatever reason. And so there are some fairly strong positive correlations here between momentum and volatility and so on. And so it's no point in throwing in a bunch of styles or factors which are actually the same as others. So we ran a principal component analysis on these factors, and you can see here quite a lot of them are kind of really covered by the first principal component. And what we did was we thought, well, we'll take the first 3 of these. We then went to identify what these were, just looking at them graphically. And the first one is actually the best measure of this is really momentum that's coming through here, but it subsumes some others. Then the second one is, in fact, the value growth, earnings yield. And we wanted to add, in fact, the third one here, which would take us up to about 90% of the explained variance here. And this one was really interest cover. And we tried to include this, and we found that we had a problem because the banks, for example, do not have interest cover as a measure which is useful for us. And so it meant leaving out a lot of companies in our sample. So we decided not to use this. So we then just went with these 2 principal components now as measured by momentum and value growth. And so we're really looking at just that portion of the data. So our thinking then was, let's look at building a 3-factor hedge fund. We're going to take all of our cash, and we're going to invest it into the all bond index. And it's going to sit essentially in the risk-free return. Then we're going to run 2 market neutral factors. We're going to take momentum and earnings yield. And those were the 2 we just found out were the best 2 principal components, if you like. And this is 12-month momentum holding for 3 months. Then what we're going to do with these is we're going to sell short the weaker portion of this, which I'll show you just now, this is going to generate us some cash, and we're going to, because we're selling these assets, we're going to then use the same money to purchase the long. So there's no cost involved over here. The cost is zero, but we can get two portfolios. In fact, later on, we can actually gear these up. It doesn't hurt us to take 4 times as much, or whatever we decide in terms of gearing. Now, what we need to do is we want to pull out just the tails of our distribution, because we saw earlier that FamaFrench tend to split the distribution in half, and you lose some of the concentration if you do that. So what we're going to do is we're going to split the distribution. So let's take momentum, for example. We're going to rank everything in terms of very high momentum all the way down to minus negative momentum over here. The top 30% of shares will go into this tail. Then we're going to leave out 40% of in the middle, and then we're going to just call that neutral, and we're going to focus on the tail of 30% down here. And so this gives us 8 combinations of possible places where a share could be. You'll see them over here. These are our 8 different styles over here. So, for example, this is looking at momentum. So P is positive minus negative momentum. And if you're a share, take SASL for example, you can either be positive or neutral or negative in terms of momentum. And similarly, SASL could be high minus low in terms of value versus growth. So this is its earnings yield. And it could either be high, neutral, or low, in fact. So you get all these combinations that we've mentioned down here. Now, we are interested in the positive momentum here, and the high, you can see this is positive, positive, positive here, and this is high, high, high here. So we want these to be our long portfolios here, and these to be our short portfolios over here. We're selling these things. And you'll see we've got neutral, sorry, not neutral, negative, negative, negative. These little dashes actually mean neutral. This is a little confusing, but if you look at all the possible combinations here, you can see, for example, we've got 2 pHs here because we want positive and high, both for this long portfolio and also for the long on earnings yield over here. And so if we look at all the possible combinations, you'll see we get 2 positives for this one, and we're adding them up over here. And you'll see that some of these are cancelling out because we've got a long portfolio and a short portfolio over here. And so this final column here is telling us what we're really looking at in terms of where we want to weight our portfolios to get what we're looking for. And so we then put this into Solver, and we put some constraints in here to say we must have 2 of these, if you like, or twice the weight here, and no weights and negative weights on these different styles that we've generated over here. And we then set Solver to maximize the Sharpe ratio. We want the highest return for the lowest risk. And we also need to check that we don't get into trouble with our cover ratio for our hedge fund. So we just note that we need to make sure that our assets are more than our liabilities, if you like. And so we've got our money sitting in cash. We're giving that a 5% haircut. We've got our long portfolio, which we're giving a 15% haircut. We're dividing that by the total value of our short portfolio, and that number needs to be above 1. So when we run this, you can see this is the result of what we get. So first of all, just to give us a benchmark, this is the all share portfolio here, total returns, and we're running this back to 1984 now, and you can see it does pretty well, quite volatile at times, some big dips here. And this here is our positive minus negative. So this is our momentum style coming through over here, and our high minus low. So this is our, well, these are really factors because we are actually subtracting stuff over here. And this is our earnings yield factor here, not quite as good. If we combine them into our hedge fund over here and run it as a hedge fund, you can see we get this pink line up here. And you'll notice that it's very stable. There are some crashes over here, but on the whole, it's pretty consistently upward and stable. So we like this. We think this gives us a good model. And if we examine the cover ratio for what we've got over here, this is just with the Sharpe ratio maximized, you can see that it is well above what our limit is here, 1. In fact, the lowest is about 2.4 somewhere over here that it ever drops to, and that was somewhere here. And so this is telling us that there is room to gear up this portfolio if we wanted to. So just summarizing the results, we find that the average gearing, this is with the Sharpe ratio being our optimized, is about only 0.5. So we're actually only putting in, if we put 100 Rand into cash, we're only selling 50 Rand and buying 50 Rand in our other two, our long and short portfolios. Our average cover ratio is about 2.7, and our return that you saw just now is about 24.3% per annum. That's pretty good, and we haven't even geared up this fund. So, okay, just to end with a few comments. This is obviously all done in sample, but you can see the trends are pretty consistent, but it's true, we don't know that this will work in the future. We do think that there's scope to actually gear this up quite a bit more and still for it to be very safe. And we haven't included the transaction costs in the hedge funds, but there will be some costs which will obviously diminish our returns slightly. And there is a possibility that there will be some concentration bias here. It's possible, for example, that Sasol could be in twice in our longs or twice in the shorts and so on. We haven't checked for that to see what effect that has. So it just, one last comment, it would be nice to have some kind of, to make this easier, to have some factor type ETFs out there, such as momentum and value. These are the two we think would be useful. And maybe kind of a market neutral, a long short like FamaFrench type factor on these would make it easier for people to invest in this kind of thing. I hope that was useful and helpful.